Yes, a very pleasant afternoon to everyone. Welcome to Veranda CA. I hope you're all preparing for your coming May 22 attempt. I firstly welcome you all to this live session organized by Veranda CA. Right? So, in today's session, we will be discussing obviously about paper number 3, Advanced Auditing and Professional Ethics. In today's session, we'll be discussing the amendments, the amendments which have come to Schedule 3 to the Companies Act. Now, this area is a very, very important area from an examination perspective, right? So, let's dwell upon this, the entire 2 hours or 3 hours that we are going to discuss over, in this entire area. We will be discussing about what are the amendments that have come to in Schedule 3 to the Companies Act. Now, what is Schedule 3 to the Companies Act? We will start from the basics, we'll touch upon the basics, and then we'll dwell upon all the amendments that have come through, right? So, let's start. So first let's understand the overall scheme of the schedule, right? It is pursuant to section 129 of the Companies Act. I'm sure you guys will know what is section 129 of the Companies Act. Section 129 talks about financial statements of the company, right? Section 128 talks about the books of accounts, and section 129 talks about the financial statements of the company, right? So I'm just given an extract of what the section exactly talks about. It's an extract of the section. The financial statements shall give a true and fair view of the state of affairs of the company or companies, comply with the accounting standards notified under section 123, and shall be in forms or forms as may be provided for different class or class of companies specified in Schedule 3. So then what is Schedule 3? Schedule 3 is basically a format. So Companies Act is said to be the most comprehensive law in India, right? So it prescribes a format. What prescribes a format? The Companies Act. Section 129 of the Companies Act prescribes a format through Schedule 3. So the format again is divided into multiple, different types of classes of companies. We will discuss about that. But Schedule 3 is nothing but a format which is prescribed by the Companies Act. Format of what, sir? Format of the financial statements. How a financial statement should be presented, in what format. Why, sir, they need to prescribe a format? The format will have to be prescribed because we need to ensure uniformity, right? We need to ensure that companies can be compared, two companies of the same industry or two companies of different industries can be compared. Therefore, we need to have a uniform format in which all the companies' financial statements can be compared. That's why we have this Schedule 3. So popularly this is called Schedule 3 to the Companies Act. Now what is financial statement? Just let me take a step back. Financial statement consists of balance sheet, consists of statement of profit and loss, consists of cash flow statement, yes, and it also consists of a summary of significant accounting policies. Okay, so for Schedule 3 prescribes this too, balance sheet and statement of profit and loss account. Statement of profit and loss. There is no statement of profit and loss account. It is statement of profit and loss. Right? Going forward. Now, structure of Schedule 3. So, just to give, again, I don't want to directly start with the amendments. I thought I'll just give a brief structure and then we'll directly start the amendments. So, this is very important from an examination perspective. We definitely will, in my opinion, will get one question in CA final, from this particular attempt, from this particular area, in May 22 attempt, because it's a very important area and this has been recently notified a year back. So, it's very, very important from an examination perspective. So, this video can be seen by CA final students who are going to give their attempt. It can be seen by article assistants who are actually doing their articleship. It can also be seen by working professionals who are into auditing. So all of everyone can have a look at this video because I've covered it quite comprehensively. Anyway, structure of Schedule 3. Just to give a brief basics of people who don't know about Schedule 3. So Schedule 3 is divided into 3 parts: Division 1, Division 2 and Division 3. Division 1, Division 2 and Division 3. So Division 1 has again Part 1 and Part 2. Division 2 again has Part 1 and Part 2 and Part 3. Division 3 again is on to Part 1, Part 2 and Part 3. So Part 1 is generally balance sheet. So all the Parts 1, if you see, it's balance sheet, this is also balance sheet, this is also balance sheet. Right? Part 2 is generally the profit and loss statement, Part 3 is generally the consolidated financial statements. It's how to present the consolidated there are some disclosures which are prescribed when the company has to prepare a consolidated financial statement. So the Division 1 is for companies who are following the IGAP. Now, when I say the IGAP, I call it colloquially the IGAP, but it is basically the companies who follow the accounting standards which are prescribed under the 2006 rules. What are the 2006 rules? Your accounting standards, AS1, AS2, AS3. So, for those companies who follow the IGAP, Division 1, that is Division 1 Part 1 and Division 1 Part 2 has to be followed. For the companies who are following Ind AS, that is 2015 rules, they have to follow Division 2, Part 1, Part 2 and Part 3. Part 1, Part 2 and Part 3. Part 1 balance sheet, Part 2 profit and loss statement, and Part 3 is your consolidated financial statement if it is applicable. Right? Sir, who will follow Ind AS and who will follow IGAP? Ind AS is, you have a separate category, it's given in the rules only who are required to follow Ind AS, who are not required to follow Ind AS. Companies that are listed, companies whose reserves and surplus is more than 250 crores or more, they are required to follow Ind AS. Others all will have to follow your IGAP. Clear? So, Division 1 is applicable for IGAP companies. Division 2 is applicable for Ind AS companies. Sir, what is Division 3? Not very relevant from an examination perspective, but Division 3 is applicable for companies that are NBFC, non-banking financial companies. So, for them a separate format has been kind of brought in Schedule 3. Division 3, NBFCs who follow Ind AS. NBFCs who follow, that is the 2015 rules. So, companies that follow NBFC will have to prepare their financials as per Division 3, Part 1, Part 2 and Part 3. I hope this is clear. This is just for your understanding. Now, let's go forward. Now, coming on to the amendments. Sir, just to give a brief on the amendments, new amendments were prescribed by the Ministry of Corporate Affairs. Why is it notification dated 24th of March 2021? So, this was the date in which MCA put one big bomb, was so many additional disclosures will have to be given. That is on 24th of March 2021. Sir, from when it is made applicable? It is made applicable from 1st of April 2021. That is this financial year. 1st April, the current financial year that we are talking about, 1st April 2021 to 31st of March 2022. All these disclosures have to be given. So, now this is March, April and May will be the audit season, April, May, June, July. So, you will find in this year when the companies prepare the financial statements, you will have to include these amended disclosures also as part of the financial statements. So, just to understand the overall nature of what these amendments are, sir, there is very minor deletions. It is all addition and additional disclosures prescribed in both Division 1 and Division 2. What do I mean by Division 1 and Division 2? That is your IGAP financials and also your Ind AS financials. Both classes of companies disclosures have been equally prescribed, and almost same disclosures have been prescribed for both IGAP and Ind AS financials. Some additional disclosures prescribe some wordings here and there. They have made changes in Ind AS. That's all. But almost the nature of disclosures are same. So, all are additional disclosures. There are hardly one or two omissions. There is no omission made. No significant omission made. It's all additional disclosure. Sir, why, sir, this is made? To enhance the transparency to the users of financial statements. So, the main purpose of the Companies Act is what? It is basically to protect the interest of the investors. How will you protect the interest of the investors? By being more and more transparent to the users of the financial statement. So, these disclosures are to enhance the transparency requirements, to become more transparent, to provide more and more information, more in terms of money laundering, more in terms of shell companies, more in terms of Benami properties, more in terms of cryptocurrency. The disclosures have been prescribed. We will discuss in detail. So, with this being the background, let's have a look at the index of the amendment. So, there are around 24 amendments which have been brought about. I am just quickly taking you through promoter shareholdings, and there is a reclassification, then there is a trade payable aging which is prescribed, property, plant and equipment reconciliation, trade receivables aging, end use of borrowings. We will go one by one in each of the caption we'll dwell into one by. This is just an index that I am giving you. Loan to promoters, CWIP aging, CWIP project completion, Benami properties, willful defaulter, quarterly returns, struck off companies, charges, layers of companies, ratio, scheme of arrangements, utilization of borrowings or premium, undisclosed income, CSR disclosure, cryptocurrency, lease liabilities, and statement of changes in equity. Most of it is applicable to both classes of companies that follow division 1 or division 2, most of it, except for here and there, except for I think for the last two, 23 and 24 are only applicable to Ind AS companies. However, the rest are all made applicable to all classes of companies, that is those who follow the IGAAP and those who follow the Ind AS. Is that clear? Now let's start with the amendments, right? The first amendment made. Now, so this entire lecture, just before I start, this entire lecture that I am giving, in this entire thing, it is most of us, what will happen in the examination, we will kind of not read these amendments. Schedule 3, you will read Schedule 3, it's there in the book, in CA final your syllabus also it is there as a separate appendix, in your company audit chapter, but who will read, na? It will just go on to other important areas, but here, generally that's how people avoid it. But here, since there are amendments, it's a sunrise amendment made applicable for your May 22 exam, therefore this is very, very important. Okay, so if you just look at this lecture, at least you will get an idea. You spend your 2 hours, if you look at this lecture, you will get some idea as to what the amendments are. You don't have to, memorize all the amendments. It is not practically possible. If there is a question on the amendments, which is generally a case study type of question or a question as to what will be the reporting requirement, you will have to reproduce it in your own words. That's absolutely fine. But at least to understand the question, you will have to, kind of see and be aware of what the amendments are. If you don't even know what the amendments are, then there is no possibility of answering the question, right? So with that intent, at least sit for these 2 hours or 3 hours and see the class. Right. Now, the first amendment is the very simple one. Inclusion of heading property, plant and equipment and intangible asset on the face of balance sheet. So if you look, so division 1 part 1. These amendments are in division 1 part 1, which is basically your IGAAP financials, yes or no, it is the IGAAP financials. So if you look at your face of the balance sheet, you will have your, your assets and then your liabilities, your liabilities and then your assets. Under your assets, you will have, first thing will be your tangible asset, CWIP, and then intangible assets, etc. So first the word, the word fixed asset has been removed because it is not in line with the accounting standards. Yes, the accounting standard as per AS itself, it prescribes the word property, plant and equipment. The word fixed asset has been completely removed. So in line, they have used the words property, plant and equipment and intangible assets. Now you have to use the heading. So under the face of the balance sheet, property, plant and equipment and intangible assets. Under that, you will have your tangible assets, intangible assets, capital work in progress and intangible assets under development, right? So these 4 things will come. So your heading has been changed. So why this is important? There are questions in the CA final examination where they will give you one format of the balance sheet and then they will ask you, where are the mistakes? So this could be one of the mistakes. They would have named it as fixed assets. Very simple, easy pickings in the examination, which you will be able to score marks. So if you don't know this, you will not be able to answer, right? So that's the first amendment. The second amendment, a very important amendment, promoters shareholding. Sir, under equity share capital, now this is applicable for both division 1 and division 2, but yeah, we are just reading division 1 for now. So anyway, so under division 1 part 1, promoters shareholding has been inserted. So every company will have to give how much is the shareholding of the promoter. How much is the shareholding of a company shall disclose shareholding of promoters as under. Okay, so one table has been, this table is also from the MCA only. This table is not made up by me or made up by someone or by Veranda. It is a table which is prescribed by the Ministry of Corporate Affairs. In this only I need this thing. So promoter name, number of shares that the promoter is holding, percentage of total shares, and if there is a change during the year. So I have diluted my shareholding or I have got additional shares from the company, that change in percentage will have to be given. Now the question is, okay, let's go forward. Promoter here means promoter as defined in the Companies Act of 2013. Sir, who is a promoter? Promoter means a promoter that is defined in the Companies Act of 2013. So if you look at Companies Act, details can be given separately for each class of shares. So if the promoter is holding sweat equity shares, possible, highly possible. Promoter is holding ESOPs, possible, highly possible. Promoter is holding equity shares, promoter is holding preference shares. In equity also you can have different classes of shares, right? Equity class A, class B. So every class of shares I need to give it separately. It has to be given. So I cannot combine that this is the total. No, it's not like that. We'll have to go by every class of shares. What is the promoter holding? Who is the promoter? That's another question, very important. Now, promoter means promoter defined as per the Companies Act 2013. It will differ from company to company, from the structure of the company, whether it's a private company, public company, listed company, etc. So, there's a very open-ended definition under Section 2, Clause 69 of the Companies Act, which defines the promoter. A promoter is a person who calls himself to be a promoter in any annual return. When the company files the annual return, if the company says this person is the promoter, then that person becomes a promoter. So that is one this thing. Second one, if there is nothing such defined or nothing such informed to the Ministry of Corporate Affairs, then any person who directly or indirectly controls the board of directors. So, as a shareholder or as a director or otherwise, or someone whom I am informing in the returns, in my annual returns, someone whom the company, one person who is controlling, or it could be a group of people also, who is controlling the board directly or indirectly. It could be a director, it could be a shareholder in any way. So, that person can be called a promoter, someone who controls the board. A third one is a person under whom or on whose directions the board is accustomed to act. Okay, again a very open-ended definition, very because it will again be very different for every class of company. Who wields the power in the company depends upon the company itself, right? How the company is formed. So, the person on whose direction the board of directors is accustomed to act, right? So, this is a broad definition of the promoter. So, the auditors will have to identify as to who the promoter. The company will have to identify as to who the promoter, right? Basis the definition that is given under the Companies Act, and basis that this entire shareholding will have to be given. So, what if there is no promoter? Say there is no promoter. Possible, highly listed companies, where the public shareholding, there are other investors on the board, or financial investors, etc. There may not be, or the board of directors is no one holds any power to control the board or something like that, or the board is not accustomed to act, or there is nothing given in the returns, then there is no promoter. So it's not compulsory that you need to give. It's more on the private companies. Private companies definitely will have one promoter. So his shareholding may have to be disclosed. It could be less than 5%, more than 5%, whatever, right? Percentage shall be computed with respect to the numbers at the beginning of the year, or if issued during the year for the first time, then with respect to the date of issue. So, the percentage of shareholding, what will be my denominator? It will be the number at the beginning of the year. Sir, the company is formed now only, sir, the first year of operation. Then at the first time when the shares were issued. So that's more on the calculation part, which is not very relevant, but still it is there. So this is on the promoter shareholding. I hope this is very clear. So this is the first amendment which has been brought about by the Companies Act, both applicable for Division 1 and Division 2, and of course Division 3 also. Okay, Division 3 I am not touching much, but it's not relevant for the examination because specific to one class of company, that is NBFC company. So we'll more on talk about Division 1 and Division 2, which is the general companies, right? Inclusion. Sir, this is very important, could be an examination question, MCQ can be asked in this. Inclusion of current maturities of long-term borrowings in short-term borrowings removed from other current liabilities. So, if you remember this item, current maturities of long-term borrowings, we used to disclose this in other current liabilities generally. That's how the Companies Act, older Schedule 3 used to tell us. In this current maturities of long-term borrowings will have to be disclosed in OCL, that is other current liabilities. Now they have omitted that. Instead, they have said, boss, nothing doing, you put it in short-term borrowings. So there if you look at your balance sheet, you will have other current liabilities, you will have your other current liabilities, trade payables, etc., and you will have short-term borrowings. So now you need to reclassify. Even it will apply for the prior year reclassification, that is 31st March 2021 that you do also, you will have to reclassify accordingly. Okay, so this has to be reclassified. This current maturities of long-term borrowings, okay, will have to be reclassified as short-term borrowings and not as OCL. Previously it was reclassified in OCL. This could be an important MCQ question, or this could be a question similar to they give a draft of the financial statements and then this will be included in OCL, but then you have to say about this is wrong, it will be included in short-term borrowings. Similar amendment or reclassification is made again in division 2 as well. Trade payables. Sir, trade payables we all know, very simple, but now trade payable aging have to be disclosed, which was not there. So again, more transparent, more aim to increase the transparency. Users need to know what are your trade payables and how have they been aging. Are they in line with what the company is showing, right? So are they aged too high? So that means the company is accumulating payables and it is not able to pay. So it's more on the liquidity or this liquidity of the company. It will affect the liquidity. So this is the disclosure which is aimed to enhance the transparency by giving some clarity on the liquidity position of the company, right? So again, the trade payables, just not like that, it is to how much is MSME, how much is others, how much is disputed MSME, how much is disputed others. When you say disputed, so there is a payable in the books of the company which is disputed. Again, there is no clarity on what is disputed, but say for example, a complaint has been filed by the MSME, then it becomes disputed dues, right? Disputed dues other than disputed MSME. So the aging is based on MSME and non-MSME, MSME and non-MSME. Right? Again, this table is prescribed under the company law. You cannot amend this here and there. It has to be verbatim what is there, right? So for trade payables due for payment, the following aging schedule shall be given. Sir, so this entire aging has to be made from due date or has to be made from the transaction, that is the invoice date, right? It has to be made from the due date. So what if there is no due date? Then you have to make from the transaction date. That is also given. Clear? So less than 1 year, 1 to 2 years, 2 to 3 years, and more than 3 years. So anything more than 3 years, we'll have to understand as to why it is more than 3 years. So previously only the total payable will be captured. Now you see more than 3 years, so all the users will know as to how much you are not paying. Clear? Similar information shall be given where no due date of payment is specified. In that case, disclosure shall be made from the date of transaction. So then I need to have two tables. For trade payables, whom due date is given, this disclosure. For trade payables for whom due date is not given, another similar disclosure. If you add both, it should match with the financial statement balance sheet, right? Now, very important, unbilled dues shall be disclosed separately. Sir, I have made provisions. It's not a payable, it's in my provisions. Okay, something which is not billed, that has to be disclosed separately. It will not form part of the trade payables. That is another requirement. So this is on the trade payable aging. Similar requirement is again given in division 2 part 1, right? That is for Ind AS companies. Next is tangible asset and intangible asset. Tangible asset and intangible asset. So inclusion of the word property, plant and equipment. Already I have explained. Now fixed asset is all gone. They have included the word property, plant and equipment. Now what is the change? So a reconciliation has to be given. So this was already given earlier. Again, they have specified. There is no prescribed format of this. There is no prescribed format of this. They have just given a reconciliation has to be provided of gross and net carrying amount of each class of asset. What is the class of asset? A land. That is a block of asset. Land, a building, a plant and machinery, furniture, vehicle, etc. At the beginning and end of the reporting period, showing additions, disposals, acquisitions through business combinations, very important. Amount of change due to revaluation, okay, and other adjustments and the related depreciation, impairment, loss, reversals shall be disclosed separately. Sir, what does this mean, sir? Opening, closing, gross block, there will be net block. So what is the reconciliation between the two. There will be addition, there will be deletion, there will be acquisition through business combination. There will be, so this has to be properly captured. One important piece of information here is amount of change due to suppose I have revalued the asset, then that has to be separately shown. That is of course there. However, if the change is 10% or more in the aggregate of the net carrying value of each class of property, plant and equipment, so materiality threshold has been prescribed. You have to separately disclose only if the change, if the revaluation is 10% or more. So this is an important MCQ in the examination, 10% or more. Very important from an examination perspective. If the change is 10% or more in the aggregate of the net carrying value. So this note, see, historically companies have been doing this, okay, all the companies, now they have brought it in the schedule where you have to give a reconciliation, okay, and this they have added multiple things, additions, disposal, acquisition through business combination, etc. All that has been added, right? So they have tried to incorporate more and more such adjustments, and for revaluation they have prescribed a threshold which is 10% or more. Clear? So similar adjustment is given again for intangible assets. Also you have to give a similar schedule. Similar schedule has to be given. Again, it is also applicable for division 2 part 1. Now, this is again an important reclassification. We saw one reclassification in other current liabilities. Long current maturities of long-term borrowings have to be disclosed under short-term borrowings now, not under other current liabilities. Similarly, security deposits have been omitted and to be disclosed under other non-current assets. So previously we used to show this under loans and advances. Security deposits used to be shown under loans and advances, long-term loans and advances. Now it has to be removed from long-term loans and advances and have to be disclosed under other non-current assets. So this long back it was actually used to be in under other non-current assets. Now again they brought it back to loans and advances. Again they restored it back to other non-current assets. So again this could be an important MCQ in the examination. Security deposit under IGAAP financials, where to show? It has to be shown under other non-current assets. It should not be shown under long-term loans and advances. Hope this is clear. Now they have also prescribed a trade receivable aging. Yeah. So trade receivable aging. A trade receivable aging, again outstanding. So how they have prescribed a trade payable aging, a similar aging has been prescribed for trade receivables as well. Outstanding for following periods from due date of payment. Again it's from due date based on how much credit you are giving, from there less than 6 months. So if you look at trade payables, it is 1 year, 1 to 2, 2 to 3, more than 3. Here it is not like that. Less than 6 months, 1 to 2 years, 2 to 3, more than 3. Again the total should match with the financial statements, right? So undisputed trade, in earlier, if you look at the earlier disclosure, considered good, so that is still there, considered good, secured, all of that is still there. Now additional aging has to be given. So it's all this is additional. What is there has already been continued. There is no omission at all. Clear? Undisputed trade receivable considered good. Undisputed trade receivables considered, management itself is thinking I am not going to get this money. That is undisputed. There's no dispute. But I am doubtful because that guy has become bankrupt, or I don't think I am going to get the money. So that again a management analysis that needs to be made. Disputed trade receivable considered good, disputed trade receivables considered doubtful. Again, there is a lot of judgment involved by the management and also by the auditor. How to validate the same, okay, and how to get comfort, how to get sufficient appropriate audit evidence regard around this. So in the earlier, trade payable is based on MSME, non-MSME. This is based on dispute. Again, there is again a bifurcation of disputed MSME, non-disputed MSME. This is based on considered good and considered doubtful. Again, you are giving a bifurcation of what is disputed, what is not disputed. The aging is based on less than 6 months to 1 year, 1 to 2 years, 2 to 3 years, and more than 3 years. One very important piece is based on the due date. Again, if due date is not mentioned, if you are not giving any credit period, there could be cases now where due date is not mentioned. In that case, then you will have to start from the billing date. Aging has to be provided basis the billing date. Okay, unbilled dues, that is your unbilled revenue, shall be disclosed separately. Unbilled revenue has to be disclosed separate. That's very, very important point to be noted. Unbilled revenue should not be disclosed here. Unbilled, similar to trade payable, same thing here also. Unbilled, where you have not billed, which is not a receivable yet, only it will become a receivable only when you bill, right? So unbilled receivables shall be disclosed separately. Now, again a very, very important, again from a purview, if amidst all these frauds that are happening, with respect to bank frauds, people take money and then people utilize, take money for some purpose, utilize it for some other purpose, to tackle all that, this important information has to be given. But the company has not used the borrowings from the banks and financial institutions for specific purpose for which it was taken at the balance sheet date, the company shall disclose the details of where they have been used. Very well. So, suppose I've got a loan. This could be an important case study in the examination. So, they will give you a case study. So, you have to give the reporting requirements. Now, this is in line with the CARO 2020 reporting requirement also. There is a specific clause in CARO which says any borrowing that you have got, and if the company has not utilized it for the purpose for which they have been utilized, that has to be, the details of that has to be disclosed. So, that clause and this disclosure in the financials have to speak to each other. They cannot be different. They have to be viewed together, right? Now, one important piece of information here, this is only borrowings from banks and financial institutions. So, I have borrowed, say, for construction of factory. I am using it for, paying my trade payables. Clearly, I am not, I am not using the funds for which I have got. So, how does the auditor take a comfort? So, auditor needs to ask what is the sanction letter against what is the reason for which the funds have been taken. Point 1. The finance department or the accounts team have to maintain a utilization statement. Have to maintain a utilization statement as to where this money is used. Sir, let me give an example. There is a money of 10 crores loan I have taken. I have taken for the construction. No, it's not a CC or something, a term loan. So, entire 10 crore has been encashed. Right now, only using 6 crores. 4 crores is still parked. What to do, sir? I have not utilized the funds, entire funds. Then that 4 crores has been parked in FD, that has to be disclosed in the financials. It also has to be reported under CARO 2020 clause also. That 4 crores has been parked, because again this is a genuine case, but there could be a lot of ingenuine cases also, non-genuine cases also, where money is utilized for the purpose for which is for which it is not supposed to be utilized. So those cases have to be disclosed here. The management has to disclose. The auditor also has to report the facts under CARO 2020. So there is no specific format. It just says the company shall disclose the details where they have been used. So the disclosure is on where you have used the funds. That is important, right? Now, specified bank note, if you remember earlier, now there is only omission in the amendments. Okay, only omission is this. So there is only omission, I think, in the amendments. Specified bank note disclosure is omitted. So what is the specified? If you remember, in 2016 there was a demonetization phase that had come. The Prime Minister, the Honorable Prime Minister, had given on one fine day in November that all the notes are banned, all the current currency is banned and new currency will be circulated. So after following that demonetization, the Ministry of Corporate Affairs vide its notification, they had brought about an amendment in Schedule 3 to the Companies Act with respect to Division 1 Part 1. There was nothing for Division 2 Part 2, it was only for Division 1 Part 1, where they had mentioned a specific disclosure. What is the opening cash as on 8th of December 2016, what is the receipts, what is the issues, and what is the closing cash balance as on 31st December 2016, some dates were prescribed. So now that disclosure was there, just like that. Okay, now demonetization is over, it's been what, 4-5 years, still we don't know what is the impact anyway. So specified bank note disclosure has been omitted, so no longer it is required. A similar disclosure was required under section 143 subsection 3, a reporting was required by the auditor, right? Under section 143 subsection 3 in the audit report, the auditor had to specify whether the disclosure is correct or not, right? So that is also consequently omitted. This is also consequently omitted because it is no longer relevant, right? So this is the only omission. Now coming on to, these informations that you saw were somewhere in the notes to accounts. Whatever we saw so far, where somewhere you have to, is it the trade payable aging or trade receivable aging, or we saw the promoter shareholding, we had to include it in the notes to accounts. Now the next set of amendments are on the additional information, that has to be disclosed as part of the financial statements. It's not yet over. This is an additional information that has to be disclosed. Now, questions can come from this area also. Now, title deeds of immovable property not held in the name of the company. So, this is very important. So, we are talking about immovable. What is immovable property? Land, building, or both. So, there is an immovable property in the books of the company. Of course, from then only I will be able to find out. But the immovable property, if I look at the title deeds, it is not in the name of the company. Sir, does it strike something in my head? If you have studied Caro 2020 or even Caro 2016 for that matter, this clause should be very, very relevant, because there is similar reporting clause under Caro 2020 or 2016 also, where if there is any immovable property that is not, it is in the books but not held in the name of the company, it has to be reported. The details of those immovable properties will have to be reported. It was only there in Caro 16, it is again carried forward in Caro 2020 also, right? However, now they've included that the financial statements also should carry details of such immovable properties that are not in the name of the company, right? So, the company shall provide the details of all the immovable properties other than properties of the company is the lessee. Okay, now for example, for Ind AS and all, you will have this financial lease, okay, which will be held as a right to use asset, that technically or legally that is not in the name of the company is not the owner. So, that is okay. That is absolutely fine. That is accepted, because legally it is not possible. Whose title deeds are not held in the name of the company. Whose title deeds are not held in the name of the company in format given below, and where such immovable property is jointly held with others, details are required to be given to the extent of the company's share. Details are required to be given to the extent of the company. That is, suppose for example, company is holding 75%, the promoters are holding 25% in their individual capacity. To the extent of 75%, 25% has to be disclosed. To the extent the details are required to be given to the extent of company's share. So, to the extent of 75%, it has to be disclosed, right? Now, what is the format? Relevant line item in the balance sheet. So, it will be property, plant, equipment, land, or it could be an investment property also. Investment property is not used for the business, it is used for just for an investment. The company is having a land and building given for rental. Okay, company is not in the business of doing any rental business or real estate. It is just there and it is used for getting some rental income. So, it is an investment property. Okay, PP, retire from active use, and others. Okay, description of item of the property, gross carrying value, most probably as per the books, title deeds held in the name of, who is the actual owner, who is the actual owner, right? Whether title deed holder is a promoter, director, relative of the promoter, director, or employee of promoter or director. So, you will have to mention the relationship with the company, of course. So, whether the promoter is the owner, which is most likely going to, again the promoter definition what we discussed earlier in the promoter sharing, same thing, or whether is a director, or it could be both, or whether is a relative of the promoter or director. Relative defined under section 2 clause 76 of the Companies Act, right? 2 clause 76 talks about there is a definition, right? All your linear descendants, all your descendants above and below and side, brother and sister, mother, father, son, daughter, brother, sister, husband and wife, and members of HUF. All these are relatives under 2 clause 76. I am sure if you read the Companies Act, you will definitely need to know what is the definition of relative. Employee or promoter of the promoter or director. So, that is also that relationship you have to disclose here. Property held since which date? Who is holding? Company is holding property since which date? Or sorry, property held since which date is from when? What is the date on which the property is bought? And reason for not being held in the name of the company. So, that's another very important. Also indicate if it is in dispute, right? So, this is the entire disclosure that needs to be given. So, relevant. So, this is again, you have to read it in, auditors we have to be very specific here, they have to read it in line with the with the Caro requirements. So, again I repeat this could be a potential examination question. Any immovable property not held in the name of the company, the company shall provide the details of all the immovable properties whose title deeds are not held in the name of the company in the format given below, and where such immovable property is jointly held with others, details are required to be given to the extent of company's share. So, for example, firstly, practically it is very difficult to find out such cases. Yes or no, very difficult, because There are, if you see, books will be my base. There are some 5 movable properties in the books. Okay. Sir, there are 5 movable properties. No problem. Caro reporting will be there. However, how will I know if there are any immovable properties which are supposed to be held in the name of the company but not held in the name of the company? So from that angle, it is a little difficult and a tricky clause. We have to get a written representation from the management with respect to accuracy of this particular clause, who the auditor will have to get. So this is the format. Again, relevant line item, description of item of the property, gross carrying value, title deeds, who is the actual owner, title deeds held in the name of. So who is the owner, whether title deed holder is a promoter, etc., whoever it is, property held since which date, and reason for not holding in the name of the company, why it is not held, also indicate if there is a dispute. So this entire area has to be disclosed. From an examination point of view, they can probably give you a case study where Mr. X is so and so, Mr. Company is so and so, company is not holding immovable property from the books of account, basis which what will be the reporting requirement. So you will have to give Caro 2020 reporting requirement from an auditor's perspective, and from a company's perspective you will have to present this particular table, or you have to mention about this particular reporting requirement depending upon the type of question. Clear? Going forward. Again, relative here means relative as per defined as per the Companies Act. Promoter here means as defined in the Companies Act. Okay, now there is a separate note here. Where the company has revalued its property, plant and equipment, the company shall disclose as to whether the revaluation is based on a valuation by the registered valuer. So if any investment property or property, plant and equipment have been revalued by the registered valuer, this fact has to be disclosed whether as to whether the revaluation is based on the valuation by registered value. So there are 3 classes of valuers. One is a immovable property, that is land and building, securities of financial assets, and the other one is plant and machinery. So the first class, that is the land and buildings, you have to get such kind of a valuer to value under the registered valuers rules 2017. Hope this is clear. Now the next one, loans and advances in the nature of loans granted to promoters or key managerial persons. Now sir, this is a very, very important clause. Okay, lot of companies get loans from directors, from the promoters, and from the key management personnel, right? It could include directors, whatever. Okay, so this B is just a heading. The main extract is this: following disclosures shall be made where loans and advances in nature of loans. So what is advance is given and then subsequently you will recover it. So here the company is given a loan. Now again, section 185 you have to invite Caro 2020, where loan cannot be given to a director of the company. Loan can be taken, loan cannot be given, especially if it's a managing director, it's a prohibition. However, if a loan is given to a promoter, a director or a KMP and the related parties as defined under Companies Act of 2013, either severally or jointly with any other person, that are repayable on demand or without specifying any terms or period of repayment, then we will have to disclose. So any loan that is loans and advances, so it will be in the books, it will be written as loans and advances, but we know it is in the nature of a loan, that is given to a director, given to a promoter, given to a key management personnel, given to a related party of all these 3, okay, either severally or jointly with any other person, that are repayable. So whenever it's required to repayable or demand, or there is no specific terms and conditions attached to the loan. This one money has been given, that's all. There is no term, there is no board resolution, nothing has been given in terms of repayment. Then it has to be disclosed in the financial statement. So this is the format. Type of borrower is the promoter, director, KMPs, related parties. Amount of loan or advance in the nature of loan outstanding, not the total loan amount, only outstanding amount. Percentage to the total loans and advances. Say for example, total loans and advances is 1000. I have given 500. Then here it will be 50%. Again, always everything has to be looked at the balance sheet date. Right, so this is on the loans and advances given to promoters, directors, KMPs, related parties. However, very important, only if these 2 conditions are satisfied, then a disclosure has to be given. I am generally giving a loan with for which repayment has been prescribed or whatever, then it doesn't have to be given under this disclosure. Okay, so it's again or condition. Clear? So this is very important. Next one, capital work in progress or intangible assets under development. This probably is one of the most challenging disclosure with respect, which is incorporated in the company. Practically, it's very difficult to kind of track this. But if the companies are properly tracking it, then there is no problem. However, a bit of challenge is, especially if the company is dumping everything to CWIP, or intangible, especially IT companies, because intangible asset and development is there. Okay, then this becomes a big challenge for the accounts team to justify to the auditors. So we saw aging. There are three types of aging we saw. One is receivable aging, then we saw payable aging. Now there's also an aging for CWIP and intangible assets under development. CWIP is for tangible assets, that is your capital work in progress. For intangible, it is intangible asset under development, right? You have to give an aging for your aging schedule. You have to give an aging for your aging for your CWIP or your intangible asset under development. Sir, I have 50 crores of CWIP and 100 crores of intangible asset development. Separate tables for both, of course. So see the way it has, this is a format prescribed under the company law, so you'll have to stick to the format. Again, less than 1 year, 1 to 2 years, 2 to 3 years, more than 3 years. This is similar to your trade payable. Very similar to your trade payable aging. What is that? Trade payable aging, same, less than 1 year, 1 to 2 years, 2 to 3 years, more than 3 years, right? But trade receivables less than 6 months, 6 months to 1 year, 1 to 2 years, 2 to 3 years, more than 3 years. So again, that is only the difference, of course, apart from the particulars. So projects in progress and projects that are temporarily suspended. This could be an important case study in the examination. So again, the way this has been structured is the management has to bifurcate the CWIP into multiple projects. Say I have, again, what do you mean by project? Project is nowhere defined. That depends upon the nature of operations of the company. Say the company is into real estate. So it's constructing residential plot in, say, place A, and it is constructing a plot in a residential park in place B. So place A could be one project and place B could be another project. I mean, say a IT company. IT company is making a software. That software is called software A, and another software for some other use for software B. Software A could be one project, software B could be another project. That purely depends on how the management defines the project. There cannot be a definition given for a project, right? So what are the projects in progress and what are the projects that are temporarily suspended? Right? Suspended means management has, now again, the temporarily suspended has not been defined anywhere. Again, it will depend upon the judgment of the management and the judgment of the auditor. Say for example, because of COVID, company was not able to get funds and therefore they had to stall the project. Or business was lost, therefore they had to stall. There could be multiple reasons. Okay. Now the word temporarily is very important. Okay. So the total there's one more comment below, total shall tally with CWIP amount in the balance sheet. Okay, so total that I give here should tally. So that means the question is, what about CWIP, which is there, but I have discontinued it permanently? That has to be either written off, that has to be either or it has to be impaired, since this thing has to be impaired because I am not going to use it. Right? Either it has to be in progress, it has to be suspended temporarily. Again, temporarily has to be substantiated or justified by the company, by the management. How it is temporarily, when are you going to stop? All these questions will come. Right? So projects in progress and projects that are temporarily suspended. So that's a bifurcation. Now, you have to again do it less than 1 year. Now, less than 1 year, this aging is of course based on how much you have invested. Yes, less than 1 year, less than 2 years, amount in CWIP for a period of. So I have CWIP, one important thing is you don't charge depreciation because the asset is not ready for use or available for use, right? So for example, I have incurred some expenditure, put it in CWIP. I have still not capitalized the asset. So from the date the entry was passed till 31st March 22, That's the balance sheet date. Whatever the period is, that has to be put here. If it's less than 1 year, 1 to 2 years, 2 to 3 years, whatever it is. So the most important thing practically is the bifurcation between projects in progress and projects that are temporarily suspended. The word temporarily suspended has a lot of judgment attached to it. It will depend upon case to case, it will depend upon company to company, nature of operations from nature to nature of operation. Clear? So this is on the CWIP. Now another disclosure again on CWIP and intangible asset under development. Okay, you will have to give completion. So it's not only the aging. Aging is the historical. I've invested so much and still it is yet to be capitalized. So less than 1 year, 1 to 2 years, 2 to 3 years, more than 3 years. Now there is CWIP. Okay, there is CWIP whose completion is overdue. There are projects, say, so whenever a project is started, say for example, in my earlier example, there is a plot A, in place A, I am going to make a residential park. The company will plan, no, okay, this much will be the maximum duration, say 2 years or 3 years or 5 years or 10 years or whatever it is. If it is more than the due, then it becomes overdue. So my completion is overdue or has exceeded its cost. There are two parameters. One is overdue projects. Second one is exceeded cost. I would have, so very important here is to look at the budget. So what is the budgeted timeline and what is the budgeted cost? If my actuals timeline and my actual cost is exceeded, then a disclosure has to be given in this fashion. Sir, will this match to my CWIP in the financial statement? Not necessarily, because all my projects may not be overdue, all my projects may not be exceeding the cost, right? So for capital, again this is applicable for both, for CWIP whose completion is overdue or has exceeded its cost compared to its original plan. So now a record of original plan has to be given to the auditor, right? The following CWIP completion schedule shall be given. CWIP less than 1 year, 1 to 2 years, 2 to 3 years, more than 1 year, project 1, project 2. So it could be, so there is no bifurcation as to, at least in the format, there is no bifurcation as to overdue projects and projects whose costs are exceeded, whose budgeted costs are exceeding the actuals. It's just given project 1. So all projects you can put it here, project 1, project 2, project 3, and you can give a timeline. Now the timeline here is to be completed. Futuristic. Again, lot of judgment. Futuristic because a lot of judgment is involved. When are you going to complete? When are you going to complete this? So to be completed less than 1 year, 1 to 2 years, 2 to 3 years, more than 3. So what is the starting point of this? What is the number recorded in the financial statements as capital work in progress and intangible assets under development? You will have to break it project wise. You will have to compare for each project what is the timeline, what is the cost, compare with the actual cost and the timeline, and then accordingly if it is fitting these parameters, you will have to give the schedule. In this schedule, you will have to discuss with the management, and say less than 1 year, say ideally the entire FS has to be prepared by the management only, but as auditor you will have to go through all this. So you will have to check all this, because if it's not in line, then you will have to qualify your opinion. So anyways you will have to discuss and check the authenticity of this schedule. Clear? So similar details to be provided for intangible assets under development as well. So I think with this we come to the end of the first set of the amendments that we are discussing. There is a lot bigger set. Additional information is not yet over. Okay, so let's break for 15 minutes. Let's meet after 15 minutes and discuss the second set of amendments. Thank you.